On January 14th, 2026, at precisely 9:47 a.m. Eastern Standard Time, Citigroup's Global Commodities Research Division published a 12-page report that fundamentally altered how institutional investors view the silver market. The report, titled "Silver in Crisis, Industrial Demand Meets Supply Reality," contained a single number that sent shockwaves through trading floors from New York to London to Singapore: $110 per ounce. This was not a speculative target thrown out during a conference call. This was not a headline-grabbing prediction designed to generate media attention. This was the calculated assessment of one of the world's most sophisticated financial institutions, backed by months of proprietary research into global supply chains, industrial demand patterns, and physical market dynamics. Citi had effectively declared that the silver market was broken, and the only way to fix it was through a price explosion that would triple current levels. The timing of this announcement was no coincidence. It came exactly 72 hours after Tesla announced production delays at their Austin Gigafactory due to silver procurement challenges. It came 48 hours after Samsung disclosed that component shortages were forcing them to redesign their next-generation smartphone architecture. And it came 24 hours after Panasonic quietly informed their solar panel distributors that delivery schedules would be extended indefinitely pending resolution of raw material constraints. Citi had been watching these developments with the analytical precision that only comes from having direct relationships with the procurement departments of the world's largest technology companies. Their commodities desk doesn't just track prices and trading volumes. They track purchase orders, delivery confirmations, and inventory levels across the entire industrial supply chain. What they discovered was a market in the early stages of systemic failure. The report's executive summary was unusually blunt for a major bank's research publication. The silver market has entered a phase of acute physical shortage that cannot be resolved through conventional market mechanisms, wrote Max Layton, Citi's head of commodities research. Current pricing models based on historical supply-demand relationships are no longer applicable. We are witnessing the emergence of a bifurcated market where paper contracts trade at substantial discounts to physical availability. But the most alarming finding was buried on page 7 of the report. Citi's analysis revealed that global above-ground silver inventories available for immediate industrial delivery had fallen to their lowest levels since comprehensive record-keeping began in 1971. Exchange warehouses in London, New York, and Shanghai that typically held months of supply buffer were operating with less than 3 weeks of inventory. This wasn't a temporary supply chain disruption that would resolve itself through higher prices encouraging additional production. This was a structural shortage that had been building for years and was now reaching critical mass. The mathematics behind Citi's $110 target were both simple and terrifying. Industrial silver consumption had grown by 340% since 2000, driven primarily by the solar energy revolution and the proliferation of electronic devices. But mine production had increased by only 12% over the same period. Silver mining is predominantly a byproduct of gold, copper, and lead extraction, meaning that production levels are largely determined by demand for other metals rather than silver's own price dynamics. This supply-demand imbalance had been masked for decades by massive above-ground stockpiles accumulated during earlier periods, when investment demand was minimal and industrial applications were limited. But those stockpiles were now exhausted. Citi estimated that global inventories had declined from approximately 2.2 billion ounces in 2000 to fewer than 400 million ounces today. At current consumption rates, visible inventories would be completely depleted within 18 months. The catalyst for immediate crisis was coming from an unexpected source: artificial intelligence infrastructure. The explosive growth of data centers required to support AI applications was creating unprecedented demand for silver-intensive components. Server processors, memory modules, and cooling systems all required substantial amounts of silver for optimal performance. Tech giants like Google, Microsoft, and Amazon were quietly securing multi-year silver supply contracts at prices well above current market levels, effectively removing hundreds of millions of ounces from available supply. Citi's research team had gained access to confidential procurement data from major technology companies through their corporate banking relationships. What they discovered was a pattern of panic buying that had accelerated dramatically in the final quarter of 2025. Companies that had historically relied on just-in-time delivery were suddenly placing orders for 6 to 12 months of inventory. This wasn't normal business planning. This was strategic hoarding driven by genuine fear of supply interruption. The silver market structure made this crisis particularly acute. Unlike gold, which serves primarily as a store of value and can be recycled indefinitely, silver is consumed in industrial processes. When silver is used in solar panels, electronic circuits, or medical applications, it becomes permanently embedded in those products. Recovery through recycling is technically possible but economically challenging, especially for small components in consumer electronics. Furthermore, the lead times for new silver production were measured in years rather than months. Opening a new mine required extensive exploration, environmental permitting, and infrastructure development, Even if silver prices doubled tomorrow, new supply wouldn't reach the market until 2029 or 2030. The industry was facing an unprecedented situation where demand had outstripped supply capability, and there was no short-term mechanism to restore balance. Citi's analysis identified 3 specific sectors where silver shortages were already constraining industrial output. The solar energy industry, which consumes approximately 130 million ounces annually, was experiencing delivery delays and quality control issues as manufacturers attempted to reduce silver loading in photovoltaic cells. The automotive sector, where electric vehicles require up to 3 times more silver than traditional internal combustion engines, was facing component shortages that were delaying new model launches. And the defense industry, where silver's unique properties make it irreplaceable in advanced weapon systems, was competing directly with civilian manufacturers for increasingly scarce supplies. The report documented specific examples of industrial panic that had previously been kept confidential. Tesla had increased their silver procurement budget by 400% for 2026, while simultaneously launching a crash program to develop silver-free battery technologies. Apple was reportedly stockpiling enough silver to maintain iPhone production for 18 months, a radical departure from their historical just-in-time inventory management. Samsung had established a dedicated silver procurement team with instructions to secure supply regardless of cost. These weren't isolated corporate decisions. They represented a fundamental shift in how the world's largest manufacturers viewed silver supply security. The metal that had been treated as a readily available commodity was now being managed as a strategic resource comparable to rare earth minerals or lithium. This shift in corporate behavior was creating demand that went far beyond normal industrial consumption patterns. Citi's commodities team had also uncovered evidence of unusual activity in the physical silver market that suggested institutional accumulation beyond industrial requirements. Large block purchases were being processed through precious metals dealers in Switzerland and London, with buyers specifying delivery to private storage facilities rather than industrial locations. The quantities involved and the patterns of purchase suggested that sophisticated investors were treating physical silver as a strategic asset class. The geopolitical implications were becoming increasingly apparent. China, which controls approximately 60% of global silver refining capacity, had implemented export licensing requirements that effectively restricted the flow of refined silver to Western markets. Russia, facing sanctions that limited their access to international commodity markets, had begun accumulating silver reserves as an alternative store of value. These developments were transforming silver from a freely traded global commodity into a resource subject to strategic competition between major powers. The technical analysis supporting Citi's price target was equally compelling. Silver had broken through multiple resistance levels that had contained prices for over a decade, suggesting that the market was entering what analysts call price discovery territory. Traditional support and resistance levels, based on historical trading patterns, were no longer relevant in a market experiencing fundamental structural changes. Options markets were reflecting this transformation in unprecedented ways. The premium for silver call options had reached levels typically associated with distressed assets or companies facing bankruptcy. But this wasn't distress pricing. This was scarcity pricing. Traders were paying extraordinary premiums for the right to purchase silver at specific prices because they understood that physical availability was becoming increasingly constrained. The futures market was exhibiting signs of severe strain that worried regulators and exchange officials. Open interest in silver futures had reached record levels, but the amount of physical metal available to back those contracts had declined to historic lows. This created a potential for delivery failures that could trigger a collapse in confidence in paper silver markets. Exchanges had quietly increased margin requirements and imposed position limits to reduce the risk of a squeeze that could force them to declare force majeure. Central banks, traditionally focused on gold accumulation, were beginning to diversify into silver for the first time in modern history. The Bank of Russia had announced plans to acquire $535 million worth of silver over 3 years, citing its strategic importance for technological and defense applications. Other central banks were quietly following suit, though most were avoiding public announcements that might accelerate market speculation. The silver lending market, where industrial companies typically borrowed metal for short-term production needs, had effectively frozen. Lease rates had spiked to levels that made borrowing prohibitively expensive for most users, forcing companies to hold larger physical inventories. This shift from a lending-based system to an ownership-based system was removing additional supply from circulation and adding to demand pressures. Investment demand was accelerating alongside industrial consumption, as sophisticated investors recognized the supply-demand fundamentals. Silver-backed exchange-traded products had experienced record inflows in the fourth quarter of 2025, with institutional investors treating the metal as both an inflation hedge and a strategic resource play. Unlike previous precious metals rallies, driven primarily by monetary concerns, this cycle was being powered by fundamental scarcity. The implications for manufacturing costs were staggering. Citi estimated that a move to 110 silver would add approximately $200 to the production cost of an average solar panel, $150 to the cost of an electric vehicle, and $25 to the cost of a smartphone. These increases would either compress profit margins for manufacturers or force them to raise prices for consumers, creating inflationary pressures that could ripple through the entire economy. Some companies were already implementing dramatic changes to their product designs in attempts to reduce silver consumption. Solar panel manufacturers were experimenting with copper-based conductor pastes, though with significant reductions in energy conversion efficiency. Electronics companies were redesigning circuit boards to minimize silver usage, accepting performance trade-offs to reduce material costs. But these adaptations would take years to develop and implement, offering no relief for immediate supply constraints. The recycling industry was scrambling to increase silver recovery from electronic waste, but the quantities involved were insufficient to meaningfully impact the supply deficit. Electronic recycling yielded only small amounts of silver per device, and the processing infrastructure to handle dramatically increased volumes didn't exist. Building that infrastructure would require massive capital investment and several years of development time. Mining companies were responding to higher prices by accelerating exploration and development projects, but the timeline for new production remained lengthy. Silver deposits suitable for commercial mining were becoming increasingly rare, and environmental regulations had made permitting processes more complex and time-consuming. Even with unlimited capital and regulatory support, new mines couldn't reach full production before 2029. The market structure was amplifying these supply constraints through financial dynamics that created additional demand pressure. As silver prices rose, mining companies with existing production saw their valuations increase dramatically, attracting investment capital that further supported higher prices. Precious metals, mutual funds, and ETFs were experiencing massive inflows from investors seeking exposure to commodity appreciation, creating additional demand for physical metal. Hedge funds and commodity trading advisors were establishing long positions in silver futures, while simultaneously purchasing physical metal for delivery, creating a squeeze dynamic where the same institutions were buying in multiple market segments. This coordinated approach was designed to profit from both price appreciation and the premium that physical silver commanded over paper contracts. The derivatives market was experiencing unprecedented volatility as option prices reflected the extreme uncertainty about future supply availability. Volatility measures that typically ranged between 20-30% had spiked above 60%, indicating that traders expected dramatic price movements in either direction. This elevated volatility was making it more expensive for industrial users to hedge their silver exposure, forcing them to accept greater price risk. International trade flows were being disrupted by export restrictions and strategic stockpiling by major producing countries. Peru and Mexico, which together account for approximately 35% of global mine production, were facing political pressure to prioritize domestic supply security over export revenues. Chile was considering similar measures, potentially removing another significant source of supply from international markets. The logistics of physical silver delivery were becoming increasingly complex as demand overwhelmed existing distribution infrastructure. Precious metals dealers reported delivery delays of 6 to 8 weeks for large orders, compared to typical timeframes of 1 to 2 weeks. Secure transportation and storage capacity was reaching limits, with specialized vaulting facilities experiencing waiting lists for new clients. Insurance costs for silver shipments and storage had increased dramatically as the value per unit weight had risen and theft risks had escalated. These increased logistics costs were adding additional premiums to physical silver prices, widening the spread between paper and physical markets. Some industrial users were establishing their own secure storage facilities to reduce dependence on third-party providers. Quality control issues were emerging as some suppliers attempted to stretch available silver supplies by reducing purity levels or substituting alternative materials. Industrial users were implementing more stringent testing protocols to ensure material specifications were met, adding time and cost to procurement processes. These quality concerns were driving additional demand for silver from trusted sources, further constraining supply. The psychological shift in how markets viewed silver was perhaps the most significant development. For decades, silver had been considered a volatile but ultimately manageable commodity with periodic price spikes, followed by inevitable corrections. That narrative had been completely rewritten. Silver was now viewed as a critical resource in permanent shortage, with prices likely to remain elevated indefinitely. This shift in perception was influencing behavior across the entire supply chain. Companies that had previously operated with minimal inventory were building strategic stockpiles. Investors who had viewed silver as a short-term speculation were now treating it as a long-term strategic holding. Even individual consumers were purchasing silver coins and bars as inflation hedges, adding retail demand to an already constrained market. The regulatory response to these developments was still evolving. with government agencies struggling to understand the implications of a critical material shortage. The strategic importance of silver for renewable energy, electronics, and defense applications was forcing policymakers to consider whether intervention was necessary to ensure supply security. Some officials were discussing the possibility of releasing strategic reserves or implementing allocation systems for critical users. International cooperation on silver supply issues was complicated by the strategic competition between major powers and the concentration of refining capacity in China. Western governments were exploring options for developing alternative refining infrastructure, but such projects would require years to complete and massive capital investment. In the meantime, they remained dependent on existing supply chains that were increasingly unreliable. The broader economic implications of sustained high silver prices were beginning to influence monetary policy discussions. Central banks that had focused primarily on managing inflation through interest rate policy were now confronting supply-driven price increases that couldn't be controlled through conventional tools. The possibility that silver shortages could constrain economic growth was entering policy debates for the first time. Citi's $110 target represented more than just a price forecast. It was a recognition that the silver market had entered uncharted territory where traditional economic relationships no longer applied. The price mechanism that had historically balanced supply and demand was broken, and only dramatic price increases could potentially restore equilibrium by either destroying demand or stimulating new supply. The report concluded with a stark assessment that resonated far beyond commodity markets. The silver shortage represents a fundamental challenge to the assumption that critical materials will always be available at market-determined prices, Leighton wrote. We are entering an era where resource scarcity will increasingly constrain technological development and economic growth. Silver may be the first critical material to experience this crisis, but it is unlikely to be the last. This transformation was occurring against a backdrop of broader concerns about resource security and supply chain resilience that had been building since the COVID-19 pandemic. The silver crisis was validating predictions that globalized just-in-time production systems were vulnerable to disruption when applied to critical materials with limited substitutability. As global markets absorbed the implications of Citi's analysis, one reality became unmistakable. The age of cheap, abundant silver was ending, and the age of strategic resource competition was beginning. The 110 price target wasn't just a number on a research report. It was a signal that the world was entering a new paradigm where control of critical materials would determine technological capability and economic competitiveness. The silver bomb that Citi had identified wasn't just a market phenomenon. It was the leading edge of a fundamental shift in how the global economy would function in an era of resource constraints. Institutional response was immediate. Within hours, precious metals dealers fielded urgent calls from portfolio managers seeking physical delivery. Swiss refineries reported processing surges, with facilities booked for months. Tesla authorized emergency purchases at 15% above spot levels. They weren't negotiating. They understood availability was becoming more important than price. Samsung announced a $500 million procurement program securing 18 months of requirements. They established global teams with instructions to purchase regardless of cost. This was crisis management. General Motors canceled 3 electric vehicle launches, citing supply constraints understood as silver shortages. Ford accelerated silver-free research while stockpiling supplies. Apple abandoned just-in-time philosophy, accumulating stockpiles while establishing long-term contracts at elevated prices. This represented complete strategic reversal driven by supply security. Defense reactions highlighted national security implications. Lockheed Martin, Raytheon, and General Dynamics received emergency authorization. The Pentagon activated protocols unused since the Cold War. European contractors faced severe constraints. Thales, BAE Systems, and Leonardo reported delays due to availability. The EU considered emergency legislation guaranteeing access. Solar industry announced production cuts while redesigning to reduce requirements. First Solar, Canadian Solar, and Jinko Solar implemented desperate measures stretching supplies. SunPower stated availability had become the limiting expansion factor. They began rationing usage across lines, prioritizing highest margin applications. Medical technology faced challenges. Silver's antimicrobial properties made it irreplaceable in surgical instruments. Medtronic, Johnson & Johnson, and Boston Scientific reported shortages forcing redesigns. These represented systematic supply chain breakdown operating smoothly for decades. Companies discovered business models vulnerable to resource constraints. Financial markets reflected panic through volatility. Mining stocks experienced swings as investors struggled calculating values at 110. ETFs became focal points for shortage exposure. Options reflected uncertainty with calls at $100 to $150, strikes trading at substantial premiums despite outrageous targets. The dollar weakened as traders anticipated resource inflation forcing accommodative policies longer than expected. The EU announced accelerated research funding. Japan launched comprehensive supply chain reviews. China maximized strategic advantage. And while maintaining export restrictions, Chinese companies expanded domestic consumption in renewables and technology, constraining competitors. Congressional hearings began questioning foreign supplier dependence. Energy Department launched emergency research, reducing requirements. DARPA initiated substitute programs, but solutions offered no immediate relief. Recycling experienced growth as companies sought alternatives. Urban mining expanded, processing waste recovering silver, but quantities were insufficient. Companies implemented closed-loop manufacturing capturing silver. These could reduce consumption 30 to 40%, but required investment while needing unavailable supplies. Quality control became concerns as suppliers attempted diluting content. Users implemented testing protocols, adding procurement costs. Supply chain trust began breaking. Electronics and renewables became expensive. Solar costs increased 15-20%, slowing transition. Smartphone prices rose as manufacturers absorbed costs. Environmental concerns created tensions in producing countries. Communities welcomed development, but worried about degradation. Governments faced difficult choices between benefits and protection. The crisis validated supply chain vulnerability. Just-in-time manufacturing was revealed as dangerous dependency for critical materials with limited substitutability. Business schools incorporated resource security into curricula. Risk management expanded, including materials assessment, as companies learned constraints could threaten business models. The shortage marked the beginning of an era where scarcity would constrain technological development. Citi's 110-ton target was recognition the world had entered uncharted territory where traditional assumptions no longer applied. The age of abundant resources was ending, and strategic competition for materials was beginning. The silver bomb had detonated, and its effects would reshape global economics for decades to come.